Back once again now with Christina Romer, the former chairman of President Obama's Council of Economic Advisors, and Ira Jersey, head of U.S. interest rate strategy at Credit Suisse. Ira, can the Fed, from what you just heard from Michael McKee, can the Fed meet its goal of maximum employment without more easing?
Well, that's a good question, because will the economy be on stable footing once they stop doing Operation Twist? And I think this is a big question mark in a lot of people's minds, because if suddenly we go cold turkey and July 1st there's no more asset purchases, if bond yields were to rise and you get a steepening in the yield curve, what will that do to the economy? And that's kind of an unknown where we don't know what the implication of that is. Now, they did leave, just reading the statement here quickly, they did leave a lot of optionality where they said that they will continue to look at the size and composition of their balance sheet. So that leaves open both QE and Operation Twist still in the statement.
Dr. Romer, do you get a sense that most FOMC members at this point anyway believe that the economic improvement we're seeing is transitory?
No, I think that, they certainly are, as I suggested. I mean, they're certainly not jumping on the bandwagon that everything is doing fine. I think one of the things that I heard in their statement, right, they said that inflation they expected to be subdued at or below their target, and unemployment to stay certainly above what they think is desirable. So that just raises the question of why aren't they doing something? And again, I just agree with Ira. I think it is likely that they need to do something, and probably will do something, in the next couple of months. At least I certainly hope so.
Back now with Christina Romer, former chairman of President Obama's Council of Economic Advisors, and Ira Jersey, head of U.S. interest rate strategy at Credit Suisse. And Ira, you were just poring over this. What caught your attention?
Yeah, the Federal Reserve did not really moderate its worry about financial conditions and about strains on the economy.
You surprised by that?
A little bit. Since the 3-year long-term repo operation that the ECB did, financial conditions have improved quite a lot. Funding conditions have improved a bit, and your systemic risk posed by the European financial sector has been reduced. And believe it or not, even the Greek default takes a big unknown off the table.
Yeah.
And clearly there's still problems in the European periphery, but the fact is that the Federal Reserve is still worried about this, although maybe the markets shouldn't have already discounted some of that pain.
Dr. Romer, let me ask, what will happen to job growth if we see GDP slowing along with productivity?
I think that is certainly my worry. Right now, what we've been seeing is probably higher job growth and certainly more declines in the unemployment rate than you would have expected, given, say, the GDP growth that we had over 2011. Right. And I think it's unlikely that kind of good luck can continue, right, and that what you need to get unemployment coming down is more rapid GDP growth. And if it slows or stays where it is, I would not expect the unemployment rate to keep coming down. And I think that's a really important point.
Ira, we have about 30 seconds left. Commerce Department reporting today retail sales increased 1.1% in February. Are American consumers doing better than Chairman Bernanke thinks they are?
Well, they're doing a little better. I think the chairman is worried, though, about the precarious nature of the consumer. I mean, if nothing else, the American consumer likes to consume, and I think there is pent-up demand. And the good thing about unemployment coming down at this point is that people are less fearful of losing their jobs. Yeah. So those people who have jobs can go out and spend a little bit, whereas there still, though, is very high unemployment, which again shows you the dichotomy in parts of the economy.
Our Fed Roundtable, Ira Jersey, head of U.S. interest rate strategy at Credit Suisse, and at Cal Berkeley, Christina Romer, the former chairman of President Obama's Council of Economic Advisors and a Bloomberg contributor. Thank you both so much.